When a company or government needs to raise capital, they typically turn to two primary financial instruments: stocks and bonds. At their core, the difference is simple. Stocks represent equity, while bonds represent debt. When you buy a stock, you're buying a piece of ownership. You become a shareholder, sharing in the company's profits and its growth. Conversely, when you buy a bond, you are a lender. You're providing a loan to the issuer, whether that's a corporation or a government, in exchange for regular interest payments and the return of your principal. Think of debt in two ways: secured debt, which is backed by assets like a building as collateral, and unsecured debt, which relies solely on the issuer's creditworthiness. Throughout this lecture, we'll dive deep into the mechanics of both, helping you understand how to evaluate these instruments and the risks they carry. Let's look closer at the mechanics of a bond. Every bond agreement has several key components. First is the par value, also known as the face value. This is the amount of money loaned to the issuer and the amount they must repay you at the end. Then there is the coupon, which is the bond's fixed interest rate. For example, if you hold a bond with a $1,000 par value and a 5% coupon, the issuer pays you $50 in interest every year. The maturity date is the light at the end of the tunnel, the specific date when the par value is repaid to the bondholder. Bonds are classified by their time to maturity. Bills mature in less than a year, notes in 1 to 10 years, and bonds in more than 10 years. Understanding these terms is crucial because while the coupon is fixed, the actual market value of the bond can fluctuate daily. Not all bonds work the same way. A zero-coupon bond, for instance, pays no regular interest. Instead, it's issued at a deep discount. If you buy a zero-coupon bond for $800 and it pays back $1,000 at maturity, that $200 difference is your profit. Then we have convertible bonds, which give the investor the option to exchange the bond for a specified number of common shares in the company, a great way to benefit if the company's stock price soars. On the issuer's side, they might offer callable bonds. These allow the company to pay off the debt early, perhaps because interest rates have dropped and they want to refinance. For the investor, this means the interest payments end sooner than expected. Finally, we distinguish between corporate bonds and government bonds, which include treasuries issued by the US government and munis issued by local municipalities. To evaluate a bond's performance in the real world, we use yield. The current yield is the annual interest divided by the current market value. If your $50 interest payment comes from a bond currently selling for $900, your yield is actually 5.5%. A more comprehensive measure is yield to maturity, or YTM, which accounts for the par value, market price, coupon, and time remaining. But with higher yield often comes credit risk, the chance the issuer fails to pay. Credit agencies rate bonds. Investment grade refers to the safest bonds, rated AAA down to BBB. Anything below that is a junk bond. These carry the highest risk but must offer much higher interest rates to attract anyone willing to lend the money. It's the classic risk-reward trade-off. Switching to stocks, equity is the money supplied by owners plus retained earnings. On a company's books, you'll see paid-in capital, the money investors contributed by buying stock. If they paid more than the nominal par value, which is often just a penny, the extra is called additional paid-in capital. Investors seek returns through two ways: appreciation, where the stock price goes up, and dividends, which are cash payments from profits. The process starts on the declaration date when the board approves the payment. Until it's paid, it sits on the books as dividends payable. Sometimes a company buys back its own shares, creating treasury stocks. There's also the contra equity account, which has a debit balance and actually reduces the total equity on the balance sheet. There are two main classes of stock you can own. Common stock is most prevalent. It gives you voting rights for the board of directors, meaning you have a say in company policy. However, dividends aren't guaranteed, and you're last in line if the company goes bankrupt. Preferred stock is different. Owners usually lack voting rights but are paid regular fixed dividends. These must be paid before common shareholders get a dime. Like bonds, some are convertibles, which can be turned into common shares later. If the company hits hard times and depreciates in value, preferred shareholders have a higher claim on assets. In a bull market where prices rise consistently, common stock often offers more upside through appreciation, while in a bear market, the fixed dividends of preferred stock provide a buffer. Finally, where do these trades happen? When a company first sells its stock to individuals to raise money, it happens in the primary market. Think of this as the factory-to-consumer sale. Once those shares are out in the world, they are traded between investors on the secondary market, like the New York Stock Exchange. This is what we usually mean when we say the stock market. The price here is determined by supply and demand, influenced by company performance and general economic sentiment. Whether you are looking for the steady interest of a bond or the ownership potential of a stock, understanding these markets is the key to building a diversified and resilient financial portfolio. To summarize, bonds represent debt where you are the lender, earning interest through coupons while managing credit risk. Stocks represent equity where you are an owner, benefiting from dividends and price appreciation. We've explored everything from the anatomy of a bond's par value and yield to the nuances of common versus preferred shares and the accounting of paid-in capital. Whether the market is bullish or bearish, you now have the foundational knowledge to navigate these instruments. Remember, a balanced approach often combines the safety of debt with the growth potential of equity. Thank you for joining us, and happy investing.